Notable moves in the bond market, sparking fears of a recession, but are those fears justified? Steve Liesman here with the answer. The answer.
That's a pretty bold statement. I do have an interesting thought on this. The 2-10 spread, that is the difference, folks, between the yields of the 2-year and the 10-year notes. It's inching towards areas where in the past it has indicated recession and done a pretty good job on it. At 28 basis points, it's one Fed rate hike potentially away from near zero, or the kind of level that has reliably predicted recession in the past. And some Fed officials have indicated they'd be unwilling to support such a rate hike, which could bring it down to zero for that reason. But minutes of the last Fed meeting say that the staff presented a new research paper titled, quoting Blue Oyster Cult, "Don't fear the yield curve." The paper suggests there are potential distortions in the 2-10 spread, including from central bank purchases around the world, along with deficit financing, and that a better way to look at it, quote, the spread between the current level of the Fed funds rate and the expected federal funds rate several quarters ahead as derived from futures market prices. Essentially, it's looking at the near-term spread or the outlook for the Fed funds rate. That indicator right now shows less concern than the 2-10. And the indicator is similar to the outlook for the Fed rate hikes and cuts. When the spread is negative, markets expect weakness and Fed rate cuts. When it's positive, they expect Fed hikes and economic strength. In other words, there's no real magic in the yield curve, folks. It's just an expression of the outlook for the Federal Reserve and the economy. The Fed's going to continue watching the 2-10 spread, but some on the Fed likely will feel a bit more at ease after this paper that shows that recession is not necessarily nigh because of this very tight 2-10 spread.
All right, Steve, thank you very much. That's the answer.
It's an answer.
An answer.
Let's hope it's
Which
the
is
right
not
one.
really an answer.
Yeah.
What do you
because
mean?
they're still watching the yield curve.
Right.
But they're not going to
they don't
be
want us to be
frightened
afraid.
by complete flattening.
Right. Well,
So
here's the thing. I think they're not going to take the same signal from it this time that perhaps they took last time or in times past. And they're also never going to dismiss any information.
Right.
They're maybe going to rely a little bit more on looking at the near-term spread and the outlook for rate hike. Look, the market continues to expect the Fed to raise rates. It's not necessarily predicting a recession if that's the case.
Interesting stuff.
All right, Steve, thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.